Today, we're diving into a strategy that's consistently outperformed buy and hold with a staggering compound annual growth rate of 134%. And I'm covering it today because it recently flagged its first bear signal in years. So in this video, I'm going to break down exactly why trend-following strategies like this could become essential as Bitcoin's market cycles continue to grow and mature. So let's get into it. Today, we're diving into something a little bit different. A long-term Bitcoin trading strategy that has not only proven to be insanely profitable, but has also worked brilliantly across every single one of Bitcoin's market cycles, which is huge because Bitcoin keeps evolving. And unlike a lot of approaches that only shine during parabolic moves and euphoric rallies, this one works whether Bitcoin is consolidating, surging, or just chopping sideways. And the blow-off tops might get smaller, the bear markets might get weirder with all the institutional flow and the ETFs, but this strategy just keeps on printing. And it's built around one of my favourite indicators, which is called the alpha flow. Now, when you first look at it on a chart, it seems super simple, and that's just by design. It's based entirely on trend volatility. It's not trying to predict the exact top or the perfect bottom because, frankly, that's basically impossible. Trying to nail exact tops and bottoms is a losing game for most of the time. Instead, it's now laser focused on one thing, the trend direction and the strength of that trend. It's basically designed to keep you in during the juicy parts of the bull market and protect you from the worst of the downside when the trend reverses. And that single focus is why I believe this will stay relevant for the next 10, 20, or even 30 years, no matter how mature or institutionalized Bitcoin becomes. Now let's quickly break down the technical side of the indicator a little more. At its core, it algorithmically maps trend direction by combining a dual EMA structure with volatility-adjusted bands. And these bands detect the shifts in market pressure before the shifts are obvious in the raw price itself. Now, to start with, the indicator calculates a fast and a slow exponential moving average of what's called the typical price, which is the average of the high, low, and close. And then these EMAs are averaged into a dynamic baseline or a basis. And that basis is then expanded using a smooth standard deviation to form the upper and lower volatility envelopes. And if you're into technical analysis, these aren't like static Bollinger Bands. They expand and contract with the actual trend volatility, and they're centered on a moving average that already adapts to speed. And these envelopes kind of act like invisible fences. Price interactions with them feed into a kind of state machine that locks the chart into either a bullish or bearish trend regime. As soon as price closes above the upper volatility envelope, the entire chart locks into a bullish regime and we get a bull flag, and we stay in that bull mode until price closes decisively below the lower envelope. And the second that happens, we flip into a bearish regime and get a bear flag, and we stay there until the next decisive break higher. And this sort of locking in of the trend direction until proven otherwise is what stops us from getting whipsawed in all those choppy markets. Now, if you didn't follow any of that, then let me put it in plain English. The indicator essentially smooths the Bitcoin price, measures how wild or calm the volatility is, wraps some dynamic bands around that price, and then only changes its mind when price punches clean through the opposite band. That's it. It's just pure price and volatility telling us when the trend is alive or dying. But enough of the theory, let's talk performance, because let's be honest, that's what we're all here for. Now, to make things concrete, we'll start in June 2012. And this is basically the beginning of Bitcoin's first real bull run with reliable price data. And we'll compare three approaches: this alpha flow strategy, a pure lump sum buy and hold strategy, and a basic dollar cost averaging with zero timing strategy. And all three of these will start with $1,000, and our first buy for all three will occur at $6. Now, in the first trade, the first bull run explodes, and the indicator keeps us in the whole way, and we finally get a bear flag exit at $545. And that turns the initial $1,000 capital into about $90,000. Then the next bull flag fires when the trend resumes at $265, and we ride it all the way to $6,200 this time. By the end of trade 2, our account now sits at $2.5 million. Then we re-enter on a new bull signal at $4,400 and exit at $8,800, which is a clean double. Then we see some sideways chopping around through 2022 before jumping back in at $9,500 to ride the previous bull market exiting just after the peak at $46,000. Now, the infamous 2021 dead cat bounce, driven largely by leverage and liquidity swings, gave us our first and only losing trade, but we still managed to limit our losses and exit at $37,000, which is a small loss compared to what came next. From there, the strategy kept us 100% on the sidelines in cash, while Bitcoin crashed over 85% during the brutal 2022 bear market that followed. And fast forward to the current bull market, when the bull trend really resumed again, we got back in at a phenomenal price of $18,000, rode the entire move up, and just recently took profits on the most recent bear flag at $106,000. Now, that original $1,000 has grown into $95.7 million. And yes, I can already hear half of you in the comments saying, of course it looks good, it only works because you started in 2012. But that's not true at all. Even if you only started using the indicator at the absolute worst possible moments, which are the bear market bottoms of any of the previous cycles, this strategy still crushes buy and hold on a risk-adjusted basis, because the edge is in trend preservation and maximizing the upside while sharply reducing the downside risk. Now let's put some hard numbers on it and compare it with the other baseline strategies. Strategy 1, which was lump summing. If you'd invested the full $1,000 back in June 2012 and done nothing but just held the coins, it would be worth about $13.9 million today. An incredible return, no question. And strategy 2, which is just classic dollar cost averaging, where you spread the same $1,000 evenly from 2012 until now, buying the same dollar amount every single week regardless of price, you'd be sitting at just under $500,000, which is still life-changing amounts of money, but obviously dwarfed by the other two strategies because you were buying a ton at the top as well. Now, the real thing here that we should be focused on, however, isn't the headline number, it's the compound annual growth rate of the investment. And this strategy delivered a staggering return of 134% compounded per year. Dollar cost averaging gave 59%, and even the lump sum approach, which benefits from one of the best entry points in Bitcoin's history, came in at 104%. And that's where this trend volatility edge really comes into play. No matter when you enter a cycle, even if you miraculously bought the exact bear market bottom, this strategy still beats conventional methods because it captures nearly the entire upside of every bull run, while completely eliminating the vast majority of the bear market drawdowns. Now, what I'm presenting you today is just the base version. It's super simple, it's one indicator, and it's mechanical entries and exits. And you can absolutely make it more sophisticated. For example, you could add rules that say, only take new bull flags if the 200-week moving average is sloping up, or only re-enter after a bear market if on-chain metrics like the MVRVC score is screaming capitulation, plus we get a bull flag. The possibilities are endless. But the beauty of this core version is its humility and its psychological benefit. It doesn't pretend to be perfect. It knows it will give back some profits at the top. It knows it will occasionally take some losses on fake-outs, and I'm totally fine with that, because over multiple cycles, staying married to the trend and divorced from the bear markets is actually what compounds capital at these absurd rates. And trend following with clear volatility-adjusted exits takes a huge amount of guesswork out of the equation. You don't sit there constantly wondering if the market has topped, or if you're missing out on a move. You don't get paralysed by FOMO when things spike, and you don't panic sell during the downturns. It's all systematic. And that's the kind of discipline that compounds over time. But before we wrap up, I want to touch on something important, which is Bitcoin's evolving behaviour. In the early cycles, we saw these insane parabolic rallies with extreme volatility, and that's where traditional strategies often blew out at exactly the wrong time. But in later cycles, things have been much more muted and increasingly driven by institutional participation. The swings are smaller, the trends are smoother, and the drawdowns definitely aren't as brutal. And I think the biggest takeaway for me in this video is that the problem with most of these top and bottom indicators that you see everywhere, they were built for retail mania. They're tuned in to catch those extremely frenzied moves. And now in this environment, they're starting to fall by the wayside a bit. And that's exactly why I think we're going to see a big rise in the adoption of trend following metrics in the future. Bitcoin might not always deliver those extreme bouts of mania, and the strategies that focus on reading the trend direction and the volatility will likely become much more relevant as the market matures. So, to quickly wrap things up, trend following strategies like this one isn't about predicting tops, bottoms, or just relying on luck. It's about systematically following the trend, reading the volatility, and letting the numbers just work in your favour. Even if you start at a less than ideal point in the cycle, these strategies still outperform both lump sum investments and simple dollar cost averaging because they capture most of the upside while keeping downside losses in check. And here's the key for me. It's not just about this specific indicator. Any robust, disciplined trend-following strategy that adapts to changing market conditions can work in a similar way. And when you combine that with patience and consistent execution from yourself, the results can be pretty impressive. So anyway, this was just a quick outline of this video, and I hope you found this useful, and it gave you some food for thought about exploring alternative strategies like this. And if you're interested in what my current take is on the latest bear flag and how I'm personally positioning in response to this signal, I've shared all these details in my latest newsletter, and the link is in the description. But anyway, thanks for watching, and I'll catch you all in the next one.